They told you to buy in Florida, Texas, and California, but in the past year alone, those states have lost more than $215 billion in housing wealth. And that money isn't vanishing, it's flowing north into places most people don't expect.
I think this is really interesting. We've actually talked about this multiple times. Here's some more data. Big picture, U.S. housing market is now worth $55.1 trillion. But the balance is shifting. Sunbelt states that dominated the boom are bleeding wealth, while Northeast and Midwest states are quietly gaining. We've talked about that before. Example, New York added $216 billion, New Jersey $101 billion, and Illinois, which we're actually in contract on a park in Illinois, $89 billion in added value.
There are pricing drops in Florida. The typical home value is $378,000, which is down 5.1% year over year. I think that's maybe more of just a slight adjustment, but this is more impactful. There is a Sunbelt oversupply. Sellers are cutting prices up to 27% in some markets on their listings. And this is something I'm intimately familiar with. There is an insurance crisis. Premiums are soaring. Insurers are pulling back out of Florida and California. Tied into a lot of that is climate risk. Hurricanes, wildfires are hitting valuations and insurability. And migration. There's slowing inflows to Florida and Texas versus a return to the Northeast Metro. I would also say the Midwest, because that's something we're looking at. We have a lot of stuff in Florida. We have stuff in the Carolinas. We actually just did something in Texas, which is, I like those fundamentals. But I would agree that a lot of migration is happening. Things are expensive. People are moving. And we are also trying to, I guess, get to the puck before it gets there, and a hockey thing. We're trying to do that in the Midwest. We like the Midwest. We're doing more stuff over there. So, what do you guys think, guys? You guys agree with this? Do you feel like we should be looking at different markets? I think one of the things a lot of investors miss this type of data shift. They're so hyper focused or micro focused on a particular asset. They're not looking at the broader market, the broader migration patterns. I will tell you though, in the Elite Mastermind, we just don't track these headlines, but we always talk about this. We're stress testing deals. We're understanding markets. We like boring, steady markets. We don't like boom bust markets. And we're looking at the playbook on how to position before everyone else is. So if you're interested in the Elite Mastermind, real quick, just click the link below, join our group. We'd love to have you. So what are we going to be telling our mastermind crew this week about this migration pattern? How do we equip people, get them prepared?
I know what I'd be telling them. Look, you either have to know the market, even in these markets in California, Texas, Florida, and there are investors that are going to win in those markets because they know those markets. And there's so many sub-markets within markets, right? And I do believe all real estate is local in and of itself, right? And so I think there's an opportunity in every market. Yes, some markets are, going to boom and some markets are going to pull back a little bit. But if you're in the game and you understand the game, you're going to be in a better position to make these, to make choices and really comes down to your investment philosophy. So even though, $215 billion in housing wealth, between those three states, $215 billion is really not that big of a number when you're talking the entire state of Florida, Texas, and California. So investors that are in those states, they're going to have to make some adjustments, but I still think there's going to be winners in those states, just like there's going to be winners in, the Northeast and the Midwest as well. But you have to know those markets. You have to know the industry. You have to know the asset class. And more importantly, you need to know the sub-markets that you're investing in. And that way you can make good decisions and make decisions according to those things.
I love that. I was gonna say that I think that anytime something happens fast, I think that you need to raise a red flag. So, for example, in the last before this current administration, the last administration, it swung left politically, right? You saw a lot of people exiting the Californias, the Washington, the Oregons, going to more red states, Texas, Florida, whatever. And I won't get political, but there was a lot of movement, I think, to the Sunbelt states due to that. COVID was also a piece of that. People had different belief structures or values and thoughts around that. And things happen really fast. I mean, how many times did we hear, the Sunbelt states are growing like crazy, like Florida's growing like crazy. People are exiting, it was incredible movement. And so I think when things happen fast and it's sort of a knee-jerk reaction to some other input inside the economy or the macro environment, then you got to ask, are those true fundamentals? Are we going to really see Florida grow at a pace of whatever percent per year over time? Or are we going to see families go, you know what, actually, I like California. I don't want to live in Florida anymore. I think that anytime a market experiences extremely fast change, the red flags got to go up versus a lot of these places in the Midwest, some of the Northeast, right, where it's steady as she goes. Nothing's happening fast. It's not this insane rush because all these jobs are going to come in or all these jobs disappeared. To me, that's a more attractive economy or a more attractive place to invest. It's steady as she goes. It's a little bit more boring. We love boring markets. Versus you're like, Las Vegas is growing like crazy. Everybody's going to Las Vegas, buying Las Vegas. And then like 2 years later, they're like, oh my God, everyone's losing in Las Vegas. It's great. Like, it's like this whole like boom bust.
Well, that's not investing. That's speculation. And I do think, like, Mitch, to your point, you're spot on. When there's rapid net migration, and COVID was a perfect example. I mean, shit, we live in Oregon and we thought about moving to Texas or Florida as well. I don't know those markets. So like, yeah, I could learn, and because I'm in the investment world, I could probably learn pretty quick. But like, you had a huge and quick net migration to some of these states, and people were overpaying, and money was really cheap. So it was very, very easy for people to borrow at low interest money, sometimes short term low interest money, but sometimes 30-year fixed too, and go buy in this growing rapid market. And they had no idea what they were paying, and they were overpaying. So a lot of these markets just pull back to where they would have been. So it's like this huge increase and then this pullback back to where it would have been. So it's not like, it's like the hype lasts on the short term. It's not like it's losing all this equity. It's just bringing it back to where it would have been without this quick, fast migration.
Well, one thing, and I love that concept, Gabe, because if you look at real estate, if you said real estate in, let's say in Florida, is just up and to the right at a slow, nice and steady pace of appreciation. Let's just say, right? If Florida experiences this, then it's probably going to experience this. It's probably going to go down because it has to equalize, right? The pendulum's going to swing, but it's always swinging around that nice trend line up and to the right. So even though it's coming down at some point, it's in the upward to the right oscillation. But the more it oscillates up, the more it's likely to oscillate down. Sorry, Trav, I stepped on you.
No, that's fine. I mean, people that try and time those oscillations are going to get burned, right? That's speculation. And that example you talked about earlier, Gabe, like someone is sitting on their 3-bedroom, 2-bath Rambler in California, and they're sitting on $2 million in equity. They sell it. They don't really care what they pay in Florida, right? They don't really, like you said, maybe they're overpaying by $100K, but that's a lot for someone that's in Florida that's watching their house values go up and down. And so I think that's a big part. And this is off the subject of markets, but it ties into what you were saying, Mitch. Anytime there's a rapid migration into anything, that's a red flag. Like, look at asset classes. We saw this. We've talked about this before. We saw this with RV parks. COVID hit. Everybody bought an RV. Yeah, the prices of RVs doubled, right? So if you overpaid for an RV company, then maybe you were in trouble. But we saw these RV parks coming across our desk, and it was just like 10 cap, 13 cap, 15 caps, all this cash flow. And people were just underwriting on what was happening during COVID. We looked at stuff prior to COVID. We looked at what were occupancies, what were rates, 2017, 18, 19, and even earlier than that. So I would say, yeah, anytime there's a frothiness to anything, whether it's a market or an asset class, I think that would be a significant red flag. Different asset classes, like at one point, office space was huge. And we were just talking about on the last show, office space is bleeding like profusely. So I do think it's really important to, I love boring shit. Great example, Dallas-Fort Worth has been booming, right? The Dallas area, now there's a lot of oversupply in multifamily. Rents are coming down, values are subdued, interest rates and insurance rates are up. These people are screwed. But that was a boom and bust market to a point. We just closed on a park, what was about 2 hours out of Marshall, about 2 hours out of Texas, and it's just steady Eddie. We go there and we like boring. We like to go talk to the sheriff. We like multiple factory jobs for our tenants. Like, it didn't boom, and it's certainly not going to bust. It's just slowly.
But this is the exact kind of thing that we talk about inside the Elite Mastermind, because our elite members, they're focused on cash flow real estate to give them financial freedom and time freedom, right? And so, yes, you can make money in speculation. You can absolutely. I've watched people speculate and make money, but I've also watched just as many people lose millions and millions of dollars speculating because they're not investing. And there's a big difference between hoping that a property will go up in value. And yes, over time, real estate will go up in value in most markets. And in a lot of cases, it'll go up a lot. But when we talk about fundamentals, we're talking about properties that work today that put the kind of money in your pocket so that you can live the life you want. And sometimes those are boring, as you like to say, steady Eddie type markets. And by the time you're going to these markets that are all hyped, you're not necessarily getting a good investment. You're buying a property in hopes it'll someday go up in value versus buying a property to put money in your pocket so you can live the lifestyle you want. Cash flow first, freedom forever.
So Gabe, I think you just nailed it. And we do talk about this in our Elite Mastermind a lot. And this is what differentiates 0 to 100 from any other mastermind and a lot of other investment thesis is that we look at cash flow. We are not focused on price. Yes, price is a piece of the puzzle, but this is a cash flow game. And when you start looking through the lens of cash flow, you look at the world differently. You make different decisions. You're not following the herd. In fact, you're doing the opposite of what the herd is doing most of the time because the herd is rushing into these markets. It's speculating. It's buying low, selling high. I hate that, by the way. I hate the whole saying buy low, sell high sets you up for a speculative approach versus solid cash flow fundamentals, cash flow, cash on cash return, DSCR. If you don't understand these, go get our book, right? Like understanding those changes the way you approach the market. And by the way, the top 1% of real estate investors, that's how they look at it. But the reason you're probably not watching other shows and hearing about this is because that's the 99%. The 1% understand investment fundamentals and they're not chasing the next shiny object. They're chasing markets where they can build cash flow and hold real estate forever.
The best part about cash flow real estate is the equity does happen over time. Like your properties do appreciate and the relationship with cash flow, you get both. But if it's cash flow first, the equity happens. Like I looked back at my portfolio of properties I bought 20 years ago on cash flow. And then it's like, oh shit, this property is worth 2x, 3x, 4x. But it was the cash flow that allowed me to hold the property. It was the cash flow that allowed me to keep that property. So you're literally making money from the property. And then you're down the road, you have an appreciation play. And then you can decide what kind of moves you want to make because appreciation does happen.
Well, you can equate this to buying businesses, right? I mean, we are buying small businesses and you buy commercial assets, right? Little cash flow machines. I mean, VC venture capitalists, I think they're speculative, but they build their formulas such that 1 out of the 10 businesses they invest in will succeed, right? But value investors like Warren Buffett, he's buying on sound fundamentals, whether it's cash flow, underlying assets, maybe buying below replacement costs in our case, things like that. Where if you're a new investor and this is your first deal and it's speculative, yeah, maybe the probability of it failing is really high. But if you're buying on boring cash flow fundamentals, then you're going to survive the long run, just like Warren Buffett.
Well, and what I love about this, though, is it's boring markets. It's boring. Maybe it's boring to understand the fundamentals and to work the math and whatever. But the results are not boring. Cash flow that feeds your family and gets you free are not boring. And the wealth, like Gabe just talked about, that's created as a result of chasing cash flow, right? Or creating more cash flow. The wealth that's generated is far beyond flipping or wholesaling or any of these other guys that have these different, right, strategies in the marketplace. And by the way, it's tax advantaged as well. And so I can't think of any other formula than following the fundamentals of real estate, buying for cash flow, force appreciating and creating wealth that's a faster wealth creator than this formula.
And it's super fun. I mean, I'm working on a deal now where it's like, I'm talking to the seller and the tenant and the lender, and it's like we're working together as a team and putting these puzzle pieces together to make the deal not just good, but great. So it's a win for me as an investor. It's a win for the seller. It's a win for the tenant. It's a win for the bank. Like, that's fun. It's the ability to get in there, be creative. It's that human element of like conversations back and forth. Like the three of us are going to be on a call together. Like, how do we work through these things to make this a great deal? We say all the time, deals are made, not found. You can find a good deal or an okay deal and make it great by manipulating these few things. I don't mean manipulating in the sense of like trying to pull one over on someone, but pulling these levers, like working with the seller, working with the lender, finding ways to mitigate risks, finding ways to increase cash flow. There's all these things you can do as an investor. To me, that's actually the fun part. Then you let it sit and be boring real estate that puts money in your pocket every month so you can go do cool shit like Travis is about to go jump on a plane and go to Europe for 20 days. Like that's what boring real estate allows you to do.
Make real estate investing great again.
I knew you were going to say that.
No, you didn't. You did not know that. So anyway.